Debunking sequence of returns risk. So this is the sequence of returns risk is actually a big fear of retirees, which is why this is an important topic. And, lots of advisors talk about all the time. And, the problem is, I think it actually leads to much worse results for most or many retirees, leads to inferior portfolios, low returns, and a less reliable retirement. So we need to look at this well. So first of all, here's what we're going to talk about today. What is sequence of returns risk? To define it. What solutions are typically recommended? What is the actual risk of running out of money with a bad sequence of returns? Do the typical solutions work? Why don't the typical solutions work? How can you get the maximum reliable retirement income, something reliable? What should you do if your risk tolerance is lower? What is your personal rule? It's rule for you instead of using the 4% rule. What solution to sequence of returns risk actually works? What dynamic spending rules are suggested by actuaries and advisors? What is Ed's dynamic spending rule, and how is it customized for you? So that's our topic for today. So first of all, what is sequence of returns risk? So basically, it's the risk that you can run out of money if you start retirement with a market crash. And that's how it's often put, like if you retire and there's a big market crash or a really bad few years, right at the beginning, it can kill your retirement. So is that really true? So I just pulled this off the internet. Here's a quick definition. So sequence risk is the danger that timing of withdrawals from a retirement account will damage the investor's overall return. Account withdrawals during a bear market are more costly than the same withdrawals in a bull market. So a diversified portfolio can protect your savings against sequence risk. So that's kind of the conventional wisdom out there. And that's the conventional wisdom that causes all the problem. So here's just kind of a picture of it. So let's say you retire here, and so if the first 15 years are bad, and then you withdraw, you're into problems. But then if the bad period is 10 years later, it's not nearly as bad for you. That's kind of the kind of picture of what it can look like. All right, so what solutions are typically recommended? And so, advisors will tell you, oh, there's a sequence of returns risk. You got to be scared of this thing. So the conventional wisdom, you need bonds or fixed income because it's going to reduce the volatility of your portfolio. So if we have a bad period, it won't go down as much. So they'll say your answer is a diversified portfolio, which is code for have a bunch of bonds or invest in bonds. These are bucketing strategy. So you have, some bonds, some stocks, some different things, and you withdraw from different buckets. Again, it's code for you got to have some bonds, or they'll say you need some annuities, which are really another form of very long-term bonds, but it's just basically fixed income. So that's always the solution, seems to be just to add fixed income. So what's the actual risk of running out of money with bad sequence of returns? Okay, so we have this big risk, sequence of returns risk. How bad is it really? So I tested it for 150 years. I've got the actual data with actual stock market returns, actual inflation. So the 4% rule is you take your investment and you take 4% out a year and you increase it by inflation every year. And success is defined as it lasted for 30 years or more. So, the average Canadian retires at age 62. If you have a couple, the second one lives on average to 92. 30 years. That's why I look at that period. So at a 4% rule, let's say you have $1 million, you take 4%, that's 40,000 a year. You increase it by inflation every year. So can you do that, reliably? So basically in history, between 96 and 97% of the time, it's been successful. So almost always it's worked. And the only time it didn't work because of a market crash or a bad sequence of events was 1929. Just before the really horrendous 80% decline. Any other time in history, a market crash did not cause a problem. So even though everyone says, oh, this is a bad sequence of returns or a big market crash can kill you, it actually, outside of 1929, it's never been a problem in the last 150 years. And actually, even then, I don't really think that would happen again today. So back then, the Fed didn't know how to manage the economy. They didn't support the run of the banks, and people started withdrawing like mad from the banks. And the Fed, in the Federal Reserve in the US, didn't support it, and in Canada, the bank. So what they did is they actually reduced the money supply by 30%. So they caused big deflation, and that's actually what made it much worse. And my opinion is if the Fed hadn't reduced the money supply, the 1929 would have been an ordinary bear market, ordinary recovery, we wouldn't have this big, huge depression. And that's what actually caused this. But and the Fed, basically the way they wouldn't make that mistake today. So, basically it's the only time it's happened in the last 150 years. And it was mostly because of a Fed error, which they wouldn't do today. So, the central bank. So, and when I show these results, the comment I often get from advisors is, well, we had this bull market the last 100 years. So in the last 100 years it worked, but not before that. But, if I look at the returns of the stock market after inflation, they're basically been pretty constant from 1800 until now. So it's 220 years and it's worked pretty well the whole time. So it's not only when we've had the big, bull market periods, it's kind of the norm for the stock market over that's what we've seen in the last 220 some years. So now the risk to your retirement is inflation, not a market crash. I'm going to show you that in a sec, but that's really what the big risk is. That's why right now we do have some high inflation, and I'm actually glad that the Bank of Canada is keeping rates high, and I think they should keep it high all the way down till we get 2.0. We actually just dipped below 3% inflation, so we're within the Bank of Canada's target range. But to my way of thinking, inflation is the big risk for our portfolios and for our retirement income. That's what all my studies have shown. So we're glad they're getting it all the way down to 2.0. So now most retirements with 100% equities really end up with 3 or 4 times more. So if you invest like this, you usually end up with a lot more, and you can actually increase your income later on. So let's look at what the graph is. So this goes from 1871, and every line is a 30-year retirement. So the very first line here is you retired in 1871 and you live for 30 years. Look, you end up with over $8 million, starting with 1 million, right? This is withdrawing 40,000 a year and increasing it by inflation every year. Now you see the zero line. The only time it got below zero here, this was 1929. It made it below zero. Any other time, it was fine. And these here were 4 of them. These were all caused by high inflation in the 70s and 80s. We had 20 years of really high inflation, and that's the killer. So you see, that's much worse here than the 80% market crash was only once a problem. 20 years of high inflation was 4 times a problem. So it's a much bigger problem. So you notice that, while you almost never run out of money, if you start with $1 million, you usually end up with 3 or 4 million or something like that at the end. So you end up with a fair amount more that you can increase your retirement later on. So bottom line is, being all in stocks through retirement has been reliable. This is not, sequence of return risk is not a big risk. So do the typical solutions work? So, the typical solution is to add bonds to reduce volatility. And you know what? This is more risky. It's not less risky. So, 100% bonds, remember 100% stocks has about a 3 or 4% failure rate. 100% bonds has a 53% failure rate. Like most of the time it fails. And so, if you say, what if you're in between? So 70% bonds and 30% stocks, it is about a 14% failure rate. So basically, and when you look at the graph, I'll show you the graph in a minute, the more bonds you have, the higher the failure rate. It's pretty well a continuous line. So, and bonds fail, if you look at 100% bonds, it fails almost all the time, except when we have long periods of time when interest rates fall, like the last, I call it the bond bubble from 1982 to 2020. We had interest rates went down about every year, and so bonds did okay. Basically, any other time in history, bonds have failed. They have not provided a reliable retirement income. So everyone says, "Oh, bonds are low risk or no risk." They're not. They are the big risk, and it's because you need a rising income in retirement, and bonds are a fixed income. So and that's why they tend to run out of money. They don't keep up with inflation. So this is 100% bonds. Okay, and notice how often you start with $1 million. Notice how often you end up below zero, like most of the time. Basically, anytime if you retired between 1890 and 1980, it's a 90-year period, you almost always ran out of money. And see, from 1980 to now, you did okay, and a little bit way back here in the 1870s. But basically, all 90 years of having bonds in there was a failure. And so when you have stocks that succeed and bonds that fail, make sure you get somewhere in between. So this is 70% bonds, 30% equities. You add it's a 14% failure rate. You see, a fair number of times you get down to zero here. So why don't these typical solutions work? Why doesn't, you think, okay, if the issue is, volatility, you don't want to have a big decline early in your portfolio, in your year retirement, why doesn't it work? So I'm going to show you, there's a few big reasons, and I'm going to show you each one of these. First of all, stocks are actually more consistent than bonds after inflation after 20 years. I'm going to show you that for a second. It's from a really important study, 200-year study. Another one is that very few people realize, but I see it because I've prepared literally thousands of retirement plans for people, and you see it that the actually 70 to 80% of a 30-year retirement is investment growth after you retire. So you still need growth after you retire. It's not like you can retire and put all your money in, under the mattress or in a savings account and just live off it. Then that's how you run out of money. So, and I'm going to show you that in a sec. And the other thing is that the more bonds, the lower the success rate of a 30-year retirement. And that doesn't matter what withdrawal rate you're at. Any withdrawal rate, the more bonds you have, the lower your success rate. So this is from the 30-year study by Professor Jeremy Siegel. This is stock market. This is standard deviation, which is a measure of volatility, or basically a measure of uncertainty, and it's a picture of risk. So these are standard deviation after inflation. So you can see stocks versus bonds versus cash. Stocks are more risky for 1 and 2 and 5-year periods, but once you get to 20 and 20-year periods or more, and 30-year periods like a typical retirement, stocks are actually more predictable than bonds. So we can more accurately predict where the stock market will be after inflation 30 years from now than the bond market. And that's why having your money in stocks is more reliable than bonds over a 30-year period. So, stocks are not more reliable short-term, 1 or 2 years, but they are more reliable over 20 or 30 years. And this is what you may see with the stock market. This is what you experience. It's down 26, then up 85, up down 17. So bull markets and bear markets, that's what you experience. But if you do it as a continuous line, you see the market just kind of tends to grow over time. The yellow periods are the bear markets, and yeah, it dips down, but it just recovers and keeps going back. And it's I think the stat is that 88% of all market declines have been recovered in 1 or 2 years. It almost always recovers pretty quickly. And that's why, it's even the big declines are rarely even a problem. And again, this is what we see, returns all over the map and a reasonable number of negative years. And so 1 year is pretty unpredictable. But once you're in for 25 years, look how predictable it is. It's always up, always over 5%. And, in the modern stock market here, it's basically always over 8% per year for basically any 25-year period. Now, here's the big shock. This is why you need growth after you retire, and this is why you still need to invest effectively, and you need a good exposure to the stock market, and ideally even 100%. So this is a modest retirement. So let's say you're 35 and you're married, you make 50,000 each, so 100,000 together. You retire at 65 on 40,000 each, so 80,000 is your retirement in today's dollars, and it's after 30 years. So you're going to retire for 30 years, from age 65 to 95 with 3% inflation. And so the income that you get, so this is if you have a balanced portfolio when you retire, this is an equity portfolio. So the income you get from age 65 to 95, rising by inflation, 8% of it comes from the money you originally put in. Between 4 and 10% comes from the growth before you retire. 82 to 88% comes from growth after you retire, and that's how you get it. So this is why it's so important to keep having growth. And I'm sure this is probably shocking, and maybe you probably don't even believe it, but we've got this, we've got the software, we've done lots of retirement plans, and it's just shocking how that is. If you take a portfolio, take a retirement plan, and you change the return to 0 after retirement, it's basically nobody can retire that way. So this is a more comfortable one. So you earn 100,000 each. So 200,000 together, you're going to retire on 75,000 each, or 150,000 a year. Same thing. So now your 30-year retirement, the money comes between 5 and 13% is what you put in. Between 15 and 17% is growth before you retire, and between 70 and 80% is the growth after you retire. So again, you still need growth after you retire. So this is actually the success rates. So this is a 5%. This is the 4% rule everybody talks about, and these numbers here relate to the 4% rule. And this is with this is a 3% up here. This is a 5%. But notice pretty well in any withdrawal, the lines are always either going down or occasionally they're flat, but basically they never rise. So there's basically no case where having more bonds made it safer. More bonds basically always made it more risky. Now, how can you get the maximum reliable retirement income? So we want a reliable retirement income. We want to make it as high as we can, but still be reliable. How do we do it? But basically, the best advice is for growth-focused investors, like the people who who follow my blogs and podcasts and our clients. The best thing usually is just to keep the pre-retirement portfolio that you were comfortable with it was within your risk tolerance, and it's got decent growth, and you've got when you retire you got 30 years in front. It's in front of you. It's long term. So the best advice in just about all cases is when you retire, keep basically the same portfolio or the same method that you had before you retire. Now, with 70 to 100% in stocks, the 4% rule has been reliable. It's been safe in history. So, and then what you need to do is you need an effective management of your withdrawal rate, which I'm going to talk a bit more. But that's really the secret to reliable retirement income is keep your pre-retirement portfolio, 70 to 100% stocks, ideally 100%, and effective management of your withdrawal rate. So, and that's why, because bonds have really always been a problem, and there's so much recommended within for basically everybody by the investment industry and advisors, and even the robo advisors all basically have bonds in there. But I've just found they don't really help you at all. Being all stocks is pretty well always better, assuming you can tolerate the risk level. So, and that's why I declared a while back the death of bonds as an effective investment. I love this thing, Elijah Bond. He's the inventor of the Ouija board, as if bonds somehow had us faked into believing they were an effective investment. Now, so what should you do if your risk tolerance is lower? So the best thing is to be 100% or between 70 and 100% equities. What if you just can't tolerate it? So what are you going to do? Well, you still have to invest within your risk tolerance. So if your risk tolerance is not that high, then you can't have the maximum reliable income. You got to have a bit lower income. And you got to remember this: lower risk equals lower retirement income. Okay. So if you can't tolerate it, invest within your risk tolerance anyway, but take a lower income, and I'll show you how much lower in a minute. So I call that your personal rule. So, the 4% rule works if you're 70 to 100% in equities or stocks. But if you're not, you should use what I call your personal rule, find out what withdrawal rate will work for you. So now, first of all, I just want to talk about for a minute about risk tolerance, because they'll say your risk tolerance isn't high enough. But your risk tolerance isn't you. It's not a fixed thing. You can learn to have a higher risk tolerance. Just like you learn how to be comfortable flying. Basically, what risk tolerance is, you get these questionnaires and people say, oh, it's high risk tolerance, and you came out as a moderate risk or a conservative risk on this questionnaire. But what does all that mean? Basically, risk tolerance is the ability to do nothing when your investments go down. That's really what it is. So if your investments go down and you have good investments, but you just do nothing and just wait for them to recover, that's what risk tolerance is. So it sounds like, it's not, this magical thing. It's like, how to do nothing, right? Just do nothing. So don't look, like what we have some of our clients, when the markets are going down, they just stop looking. Like, you have online access, you can see your portfolio every day. But, if it's going down, just don't look, because you know what? The human gut is going to, try to say you need to do something. And you shouldn't. Basically, anything you do at that point is probably dumb. So just, leave it as it is. And then when the markets are going up, you'll look, it's fun to look every day and wow, look how much it's growing, right? But then when it's going down, just don't look, or basically you got to be able to have your own method to do nothing. And you can learn to do that. We help our clients, get educated about stocks. Part of it is also getting educated and understanding that stocks are reliable over the long term. And, part of it is just, once you have that confidence, then you can just do nothing when your investments go down, and it works for you. So you can learn to have a higher risk tolerance. Now, your personal rule, this is what it is. We have the 4% rule, which is kind of catchy. And I came up with the rule that actually works from the study. And the rule is this: it's 2.5% plus 0.2% for every 10% in stocks rule. Now, what I found is it's not very catchy. It didn't really catch on. So I'm calling it your personal rule. And basically what it is, alternative for the 4% rule based on your risk tolerance. Okay, so just to understand this, so 2.5%, if you're 100% bonds, then what's reliable is 2.5% withdrawal rate, not 4. Okay, if you're 10% in stocks, you add 0.2, so that's 2.7. 20% in stocks, you go to 2.9, and that's, and that's basically what is reliable, what has been reliable in history. So look at the asset allocation you're comfortable with, and then set your withdrawal rate accordingly. Okay, so again, so it's the lower risk means lower income when you retire. You need, your investments can't support the same income if you invest more conservatively. Okay, now a lot of retirees use what's called the age rule. So your age in bonds, you're 70 years old, so I have 70% in bonds. You're 80 years old, have 80% in bonds. Well, over a 30-year retirement, from age 65 to 95, you're probably going to average about 80% in bonds. So so it's a 3% rule then works, not 4% rule, if you're going to use the age rule. Now, also, when I talk about with some advisors, especially online, someone will say, first of all, it's not a rule. And that's true. It's not a rule. It's, it's a guideline. It's just meant as a guideline. It's not like it's hard and fast. If you're anything over, then it's bad, or anything under is good. It's a rough guideline. And, it gives you a sense of how much you can reliably withdraw. So there's cases of, if you take 5% and 4 and you're in stocks, you're probably going to be okay. But, your chance of failure then is noticeably higher. It's not 100%, but it's somewhat higher. So it's a guideline. So now the highest success rate, if you want to have, in retirement, when you retire, I want to be able to tell you, what, you can retire and you can take this income and you can adjust it for inflation as your cost of living rises. You can just take the same amount more and live the same life all your life, no matter how long you live. And that's the confidence you want to have when you retire, that you're going to be able to retire for, even if you live exceptionally long, you want to know you're going to be fine. So to have between 95 and 98% confidence of success, you can take 4%, you can withdraw 4% a year from a proper equity portfolio if you have 70 to 100% in stocks, but only 2.5% if you're 100% in bonds. And so here I've showed this, so between 98 and 95% confidence. So you take the 98, it's better to be 98% confident. So you're almost 100% confident. So you see it's about 3.94% is what it's been here for 70 and up. And then it declines and it's really 2.6, but you should be around 2.5% if you're all in bonds or fixed income. All right, so what solution to the sequence of returns risk actually works? So, adding bonds makes it worse, not better. What actually works is dynamic spending rules, which bottom line means you reduce your spending if your withdrawal rate is too high. So you start taking 4% a year, and then it'll adjust, because if your investments will go up and down, and you're increasing your withdrawal by inflation every year, and you just monitor where it is, and occasionally you'll see, my withdrawal rate is going high. It's either because the market went down or because your spending went up. Now, if it gets too high, then you should reduce your withdrawal rate somewhat. So that's basically what dynamic spending rules are. Now, there's all kinds of ways to do this. Okay, now actuaries and advisors have come up with a bunch of, what they want to do is come up with automatic formulas. A rule, just follow this formula and it'll tell you exactly what you can do. And there's a bunch of them out there. The most common ones are called the Guyton-Klinger strategy and the Hebler autopilot. And so, which are, kind of complicated formulas. Another one that's just used often by advisors is T-SWIP funds. So basically you can take a T4 fund, you take a T8 fund that pays 8% of your portfolio and you use it for half your portfolio. So with a T4 portfolio, what happens is it's taking 4%. So every year it takes the December 31st balance of your portfolio and takes 4% of it, divide by 12. That's what you get for the next year. Okay, now this is always going to work. You're never going to run out of money with this. Why? Because if there's a 30% market crash, you're just going to reduce your income by 30% for the next year. So, and then if it's low, whatever it's lower, you're just going to take, you're always going to take only 4% out every year of whatever it is. So you'll never run out of money this way. Okay. And it's automatic, and it's 100% effective. The one thing about it is it can be a pain because, if your income actually drops by 30% in a year, that's a lot. Can you actually be comfortable with that? And that's why you need something that's going to work it out, manage it much more effectively, not these abrupt big increases and decreases. So this one would work, but is, not necessarily recommended for most people. Now, the one that we use for our clients, we've kind of developed our own method, and basically we actively manage it. Okay, so we have our proprietary method we use for our clients, and we monitor where it is, and we actively manage it. And it's very client specific, okay, because it depends on your ability to reduce your spending. So because we get to know our clients well, we can see, like, if a lot of your retirement income is discretionary spending, dinners and entertainment and trips and renovations and things that you could easily reduce, then it's okay to take a higher amount and live more comfortably, because you have a bad year, we say, you know what, you got to take 10 or 20,000 less next year. And well, you can do that. So if you can do that, then it's fine to take a higher amount. But we have some of our clients, we can see they need all the money. They can hardly take a decline. In that case, it's better to start reducing withdrawal rate earlier and make sure it doesn't get too high, because we never want to be forced to do, a big withdrawal. By this actively managing it, that's what actually works. And I'll give you an example. So, the worst case scenario, we have seen it, and this is part of what gives me confidence. So we had clients that saved up based on the retirement goal. They needed a certain amount of money to retire comfortably. They achieved that amount. They retired. Everything was perfect. Unfortunately, it was 2008. So 6 months after they retired, their investments were down 40%. Now, that was the biggest decline since the Great Depression in the 1930s. 40% decline. So 6 months after they retire, they're down 40%. What a huge shock. So that is the worst case scenario. But what did we actually do? So we just kept sending their retirement income that was in their plan. So they still got their regular retirement income. Now, in a few cases, we had to use the dynamic spending. In a few cases, we reduced the income by 100 or 200 or 300 a month for a while till it recovered. But then, 2-3 years later, that actually the investments had all fully recovered and they were all the way back up again. So that was, the worst case. The worst case in the last 90 years happened, and it was fine. So this is why we're not scared of this sequence of returns risk. We're not scared of it, because a big crash is not the problem. It's inflation. If we get high inflation, we have to manage this much more. But don't be scared of a big market crash when you retire. It will be fine. All right, so debunking the sequence of returns risk. What we talked about is, what is sequence of returns risk? What solutions are typically recommended? What's the actual risk of running out of money with a bad sequence of returns? Do the typical solutions work? Why don't the typical solutions work? How can you get the maximum reliable retirement income that is reliable and as high as you can? What should you do if your risk tolerance is lower? What is your personal rule for you that's instead of the 4% rule? What solution to sequence of returns risk actually works? What dynamic spending rules are suggested by actuaries and advisors? What is Ed's dynamic spending rule? And how do you customize it how is it customized for you? All right, thanks for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. Also, my blog is #1 in Canada for a financial planner. I also have a YouTube channel and a podcast. You can find me by the podcast is edrempel.com/listen. The YouTube channel is edrempel.com/watch. And if you're interested in talking to us about potentially being a client, or find out whether or not we're a fit, if you go to edrempel.com/talk, or just look for a contact on our blog and look for a free 30-minute consultation. Fill out the form, just tell us very briefly what's about you, and one of our advisors will call you and just see whether or not we're a fit to be able to work together. So thanks again for listening, and we'll see you next week.